What is Form 1099-DA? IRS Crypto Reporting for Wallets and Trades, a 2026 guide. Written by Clinton Donnelly, the CEO and founder of CryptoTaxAudit, and read to you by Senior Account Manager Liam Higgins. You pull a 1099-DA form from an email from Coinbase. You've never seen this form before. It's new for 2026. And it lists everything. Every crypto sale you made in 2025. Every time you've transferred funds off an exchange, and the wallet addresses where those funds landed. Then it hits you. The IRS got the same form in January. They know what you sold. They know where you moved it. And if you don't report this form on your tax return, they're going to assume you owe them money on every dollar listed. Here's what Form 1099-DA actually reports and why it matters more than any tax form you've ever dealt with before. The 1099-DA stands for Digital Assets. It works like any other 1099-DA form, but it's specifically built for crypto. Any centralized exchange with US ties has to generate these. Coinbase, Kraken, Gemini, Uphold, Robinhood, Fidelity, Franklin Templeton, Swan. If the exchange operates in the US, they're reporting. The form shows every sale and transfer you've made on that platform, not purchases. Those aren't taxable events, so they're not included. But if you sold crypto or moved it off the exchange, the IRS sees it. Anyone who sold or transferred assets from a US central exchange gets one. DEX users and DeFi traders won't receive these forms. Decentralized platforms currently don't have the same reporting obligations as centralized exchanges. But if you touched Coinbase, Kraken, or any US exchange in 2025, expect a 1099-DA in your mailbox this tax season. So what shows up on the 1099-DA? The first year of 1099-DAs only reports proceeds. That's the total value of what you've sold. No cost basis, no purchase price, just big numbers sent to the IRS. The exchange needed time to modify its systems. So, for 2025, the IRS sees your gross sales but has no clue if you made money or lost it. They just see dollar amounts. Starting with the 2026 tax year, exchanges will report cost basis if they have it. But here's the problem. They won't always have it. If you bought crypto on one exchange and transferred it to another before selling, the selling exchange doesn't know what you paid. The cost basis field stays blank. The IRS sees the sale. They don't see your loss. Why wallet addresses matter more than you think. Here's where it gets serious. The 1099-DA includes wallet addresses for every transfer off the exchange. So, let's say you bought $1,000 of Bitcoin on Coinbase. You transfer it to your Ledger hardware wallet. That wallet address goes straight to the IRS on the 1099-DA. They won't know it's your personal ledger, but they know the address exists and they can trace it. Over time, the IRS can map your entire crypto portfolio by tracking wallet-to-wallet movements. Every transfer from that initial address to other wallets starts to paint a picture of your holdings. This isn't just Bitcoin. It's every coin you trade and every wallet you touch. The IRS is building a multi-year view of your crypto activity. That's why this form matters more than any 1099 you've ever dealt with before. So what happens if you don't report the 1099-DA? Not reporting a 1099-DA on your tax return triggers an IRS matching system. When you file electronically, the software flags every 1099 you include. The IRS cross-checks it against what they received from exchanges. If something's missing, they notice. You'll get a CP 2000 notice. That's the IRS saying, you didn't report this income. We calculated what you owe. Here's your bill. They assume 100% profit because they don't have your cost basis. A $50,000 sale becomes $50,000 of taxable income in their eyes, even if you lost money. The CP 2000 is not an audit. It's worse. It's an automatic income assessment, and it puts you on the IRS's short list of crypto underreporters. You have to report every 1099-DA on your return, even if the numbers are wrong. We cover how to handle incorrect 1099 reporting in our 1099 DA resource guide. People have complained loudly about wallet address disclosure on the 1099 DA. The IRS has said that wallet addresses are not sensitive information. They claim that data gets transferred securely and stored privately. Their position: trust us with your financial identity. Sounds good. But here's what's actually happening. The IRS is collecting years of wallet addresses tied to your social security number. They can trace funds across wallets. They can build a complete picture of your crypto holdings without asking. This is financial surveillance at scale, and it started this tax season. How crypto moves between exchanges and wallets get reported. Let's walk through a typical transaction cycle. You buy Bitcoin on Coinbase. That purchase isn't reported on the 1099 DA because buying crypto isn't taxable. You transfer the Bitcoin to your private wallet. Coinbase reports this transfer on the 1099 DA, not as income, as a transfer. The IRS sees your wallet address but doesn't know it's yours. You transfer that Bitcoin to Kraken months later. Kraken reports the deposit on their 1099 DA. They list your original wallet address as the source. You sell the Bitcoin on Kraken. Kraken reports the sale. But they don't know what your cost basis is because you bought it somewhere else. That field stays blank on the 1099 DA. The IRS now has 3 data points: your original purchase exchange, your wallet address, and your sale on a different platform. They see a transaction trail. They just don't know your actual profit or loss. This is why proper documentation matters more than ever. The IRS has the skeleton of your trades. You need to provide the complete picture on your return. What mining and staking rewards mean for the 1099 DA reporting. Mining done privately doesn't generate a 1099 DA. You're not using an exchange or third-party service, so there's no reporting obligation on their end. But if you use a mining pool or a cloud mining service, that service may issue a 1099 DA for your mining income. Validators face a gray area. If you're validating through your own node, you probably won't get a 1099 DA. If you're using a staking service that pools funds, they might have reporting obligations. The regulations haven't fully caught up with the proof of stakes systems yet. Expect this to clarify over the next few years as the IRS sees how these transactions flow. For now, if a third party controls or processes your staking rewards, assume they may report it. The simple investor strategy: keep everything on one exchange. If you're not moving crypto off exchanges, the 1099 DA system actually works in your favor. Let's say you do all your trading on Coinbase. You never transfer to a private wallet. You never use multiple exchanges. Well, Coinbase knows your complete cost basis. They report everything: what you bought it for, what you sold it for, and your profit or loss. Starting with the 2026 tax year reporting for 2025 activity, this looks exactly like a stock brokerage 1099B. You take the profit number from the form and you put it on your tax return. Done. Easy. Stock traders have worked this way for decades. The 1099B reports everything accurately because the brokerage sees the whole trade life cycle. But most crypto investors don't work this way. They move funds between exchanges, they use hardware wallets, and they hold assets across multiple platforms. That's where the 1099 DA becomes a nightmare. Cost basis gets fragmented. Exchanges report transfers without context. And you're left proving to the IRS that you didn't make the profits they think you did. What should you do right now? First, expect a 1099 DA from every US exchange that you used in 2025. Second, don't ignore these forms. Every single one needs to show in your tax return, even if the numbers look wrong. Third, document your cost basis now. If you bought crypto on one exchange and sold it on another, you need records that connect those transactions. And fourth, if you transferred crypto to private wallets or between exchanges in 2025, map those movements. The IRS has the wallet addresses. you need to explain what happened with those transfers, because the IRS isn't guessing anymore. They have transaction data flowing in from every major exchange. Your job is to make sure your tax return matches their records and tells a complete story of your actual profits and losses. If you're a high volume trader, you're already on the IRS's radar. The 1099 DA reporting system targets one group harder than anyone else: traders with high total positive income. Total positive income, or TPI for short, is the sum of all your wages and investment proceeds without subtracting the costs or losses. If you're trading frequently or moving large amounts, you can hit $400,000 in TPI without being anywhere near that profitable. The IRS has been focusing audit resources on individuals with TPI over $400,000 since 2024. And with 1099 DAs now feeding them detailed crypto transactions, that focus is only getting sharper. If you're in this category, waiting for a CP 2000 notice or audit letter isn't a strategy, it's a gamble. CryptoTaxAudit's TaxShield membership is built specifically for high-volume crypto traders who need ongoing IRS monitoring and defense. The service includes audit representation, IRS letter review and response, and debt resolution services. It's not a one-time fix. It's continuous protection that starts with a risk review of your past filings and catches IRS problems before they turn into audits. If you're already getting notices or you know your past returns have issues, TaxShield handles the response while you focus on trading instead of the tax code.